Most people think owning some gold or silver automatically means they're protected, that just having exposure puts them on the safe side of what's coming. But history shows that's not how monetary transitions work, because in every major financial shift, the people who thought they were prepared were often the ones who were underprepared. Not because they owned the wrong assets, but because they owned too little, owned them incorrectly, or misunderstood what those assets were actually supposed to do when the system came under real stress. As we sit here on December 28th, 2025, with gold trading around $4,500 per ounce and silver near $79, that distinction is becoming even more critical. The environment we're entering in 2026 is not a normal economic slowdown. It is a structural transition involving skyrocketing debt, now exceeding $38.4 trillion in the US alone, persistent inflation pressures, liquidity strains, and eroding trust in fiat currencies. And in that kind of environment, vague exposure is not the same thing as real protection. The reason this conversation matters right now is because positioning for safety must be done before stress becomes obvious, not after. By the time the majority feels unsafe, the opportunity to position properly has already narrowed significantly. This is why the question isn't whether gold and silver will matter in 2026. They clearly will. But how much is actually enough to make a tangible difference? There's a massive gap between owning metals symbolically and owning them functionally. And that gap is where most people get caught off guard. To understand what enough means, we must first clarify what gold and silver protect against. They aren't magic assets that prevent volatility or eliminate all risk. Their core function is preserving purchasing power during monetary disruptions, policy errors, and confidence shocks. They serve as monetary insurance, not primary growth engines. Insurance only works when sized appropriately to the risk it's offsetting. The risk profile for 2026 is unprecedented compared to typical recessions. It's not just about GDP dips or rising unemployment. The heart of the issue is debt saturation. Global public debt, approaching 100% of GDP, combined with intense political pressure on monetary policy. Governments face debt burdens that can't be serviced without sustained inflation or financial repression. Central banks are caught between defending currencies and propping up markets. History shows they prioritize markets, with severe consequences for savers. When real yields are suppressed, currency purchasing power erodes, and financial assets rely on endless policy support. Tangible monetary assets take on an elevated role. Gold acts as the premier credibility hedge against debasement, while silver offers a hybrid hedge linking monetary stress to surging industrial demand in green energy, electronics, medical applications, and defense tech. This dual role explains silver's sharper volatility and potential outperformance during transitions. Holding one without grasping the other's role creates dangerous imbalance. Let's delve deeper into historical precedents to illustrate this point. Consider the 1970s inflationary period in the United States. Following the abandonment of the gold standard in 1971, inflation soared, peaking at over 13% in 1979. During this decade, gold prices skyrocketed from about $35 per ounce to over $800, a gain of more than 2,200%. Silver performed even more dramatically, rising from around $1.30 to nearly $50 per ounce in early 1980, driven by both monetary fears and industrial demand. Those who held minimal amounts, say 1-2% of their portfolio, saw some benefit, but it was negligible compared to the erosion of their fiat savings and bonds. In contrast, investors with 10 to 20% allocations in precious metals preserved and even grew their real wealth, offsetting the double-digit inflation that devastated traditional portfolios. Fast forward to the 2008 global financial crisis. Gold rose from about $700 per ounce in late 2007 to over $1,800 by 2011, a 170% increase as trust in banks and paper assets crumbled. Silver, again, showed its leverage, surging from $14 to nearly $50, a 250% gain. But many who dabbled with small positions sold during the volatility spikes, missing the full recovery. The lesson? Token holdings provide psychological comfort but fail functionally when systemic stress hits. Now applying this to 2026, converging pressures are intensifying, accelerating government refinancing interest costs, devouring budgets. Net interest payments hit $981 billion in the last 12 months as of October 2025. Political cycles pushing central banks toward growth over currency stability. Global reserve currency trust is fracturing amid sanctions, trade wars, and geopolitical realignments. These aren't hypotheticals. They're manifesting in policy and markets today. Central banks are signaling this loudly through actions. Despite record prices, they're accumulating gold aggressively, on track for over 1,000 tons in 2025, following similar volumes in recent years, to minimize counterparty risk. When currency issuers hoard non-printable assets, it reveals their view of the future. Individuals should heed that. Silver layers. Additional dynamics, It's consumed industrially, with demand exploding in solar, projected to use over 100 million ounces annually by 2030. EVs, 5G infrastructure, and medical devices, while supply lags due to mining constraints and byproduct nature. Most silver comes from lead/zinc/copper mines. This creates volatility but immense upside in scarcity scenarios. Sizing silver requires even more caution than gold. Breaking down silver's industrial uses. In photovoltaics, silver paste is essential for solar cell efficiency, with global solar installations expected to double by 2030 amid net zero pushes. Electronics rely on silver's superior conductivity for circuit boards, switches, and batteries. Medical applications include antibacterial coatings and imaging. Defense tech uses it in missiles and radar. As these sectors grow, driven by energy transition, digitization, and security needs, silver's floor price strengthens, amplifying its monetary hedge during crises. One common mistake is applying percentage rules without context, like 5 or 10% in precious metals as a universal truth. Allocation isn't about mimicking model portfolios. It's about aligning exposure to your specific risks. Someone with high leverage, minimal savings, and finance-tied income requires far more than a low-debt individual with diversified streams and robust cash flows. Enough is relative, yet not arbitrary. To make this concrete, let's consider allocation examples for different profiles. Investor profile, run risk factors, suggested metals. Allocation, gold-silver split. Rationale, are you a young professional, age 30, high income, no debt tech job. High market exposure, inflation risk, 10-15% of net worth, 70/30 to balance his growth assets. Silver for upside in tech demand, family with mortgage, age 40, dual income, kids, debt service, education costs, 15-20%, 80-20, prioritizes stability, gold heavy to hedge housing, inflation, retiree, age 65, fixed income, low debt. Purchasing power erosion, medical expenses, 20-25%, 90-10, maximizes preservation, minimal silver to avoid volatility. Business owner, age 50, variable income, diversified, economic cycles, taxes, 12-18%, 60-40, leverages silver for industrial ties, flexibility key, high net worth, age 55, multiple assets, global exposure, geopolitical currency risks, 15-25%, 75-25, includes physical for sovereignty, rebalances annually. These are starting points, adjust based on personal assessment. Use tables like this to visualize and customize. Time horizon is another blind spot. Gold and silver don't shield against short-term swings. They preserve across full cycles. Those who sell during drawdowns often bought for misguided reasons. True protection assets feel burdensome in bubbles. They're designed to prevent wipeouts when bubbles burst, not to chase euphoria. Psychologically, conviction is essential. Metals underperform for long stretches while bubbles rage. That's insurance's price. Those intolerant abandon positions prematurely. Enough must be holdable without constant doubt. For some, covering a year's expenses and severe debasement. For others, shielding long-term savings from repression. No universal number, but minimal tokenism won't scale in real stress. Avoid anchoring to nominal prices. Is gold expensive at 4,500 plus? Context is currency supply explosion, M2 up 25% since 2020. Debt mountains eroding purchasing power. In money creation outpacing production worlds, nominals mislead. What matters is real buying power over time. Here's a look at gold's historical performance over the last 10 years. From around $1,200 in 2015 to $4,500 today, with spikes during crises like COVID-19, up 70% in 2020, and recent geopolitical tensions. This chart underscores its role as a long-term hedge, practically sizing enough. Define your protection goal for pure purchasing power preservation. Amid inflation, currency weakness, gold excels consistently. For added leverage from monetary plus industrial stress, silver amplifies. Neither should overwhelm your finances, exposing you to excess volatility or illiquidity. Liquidity is overlooked. Physical metals aren't as fluid as cash, stocks, and crises. Their strength and weakness. Build metals atop emergency buffers, 6 or 12 months expenses in liquid assets. Not instead. Skipping this leads to forced sales at lows. Ownership forms matter deeply. Physical bullion, bars, coins, eliminates counterparty risk, but requires secure storage. Home safes, bank boxes, or depositories like those in Singapore or Switzerland. Tax implications vary. In the US, physical metals held over a year qualify for long-term capital gains, up to 28%, while ETFs might trigger collectibles tax. IRAs can hold metals but require custodians. Consult advisors. Poor planning erodes gains. Common myths debunked. Myth 1, gold pays no interest. No. True, but in negative real yield eras, like now with inflation rates, its opportunity cost is low. Myth 2. It's too volatile. Annualized volatility, 515%, less than stocks, awesome 20%, and negative correlation aids diversification. Myth 3. Supply will flood market. Mining output flat at 3,500 tons a year. Recycling limited. Demand outpaces. Sequence matters for 2026. Events unfold in waves, inflation surges, lagged responses, complacency to panic swings. Gold often fronts confidence crises. Silver accelerates with liquidity floods and visible inflation. Grasping phases avoids emotional errors. Scenario-based thinking for 2026. 1. Mild recession. Base case, 40% probability. GDP, 1 to 2%. Unemployment, 6%. Policy, rate cuts, QE. Gold plus in 20, 30%. Silver plus to 30, 50% as hedges shine. Allocation, stick to 10, 20%. 2. High inflation, 30% probability. CPI 5, 8%, driven by supply chains, topped or debt. Gold plus 40, 60%. Silver plus 60 or 100% on industrial pull. Increase to 15, 25%. 3. Currency crisis, 20% probability. Dollar weakens, 20%. BRICS alternatives rise. Gold plus 50, 100%. Silver, 100, 200%. 20 to 30% allocation critical. 4. Geopolitical shock, 10% probability. Wars, sanctions escalate. Gold, silver explode, physical premium. Max protection, 25% plus. These probabilities are illustrative. Prepare for tails. Geopolitical dimension, de-dollarization accelerates with BRICS plus expansion, now 10 members. Alternative payment systems and sanctions backlash. Central banks diversifying. Gold reserves up 10% since 2022. Individuals hold internationally if possible, reducing single jurisdiction risk. Combining gold - silver thoughtfully, gold for stability, credibility, silver for optionality, leverage. Balanced, they complement. Mishandled, they compound errors. Aim, minimize regret, not maximize hypothetical gains. No one size fits all, but historical monetary stress periods, 1970s inflation, currency crises, repression eras, show preservers held meaningful non-system assets, often 10 to 25% net worth in metals, varying by debt to income geography. Below, to over 10%, psychologically soothing but financially negligible. Above 25%, volatility to liquidity issues for cash flow reliant. Within metals, gold is anchor, lower volatility, global liquidity, pure monetary tie. Silver, volatile, industrial / speculative sensitive, preservation via gold, amplification via silver. Conservative, Barbayan, 2 to 3 gold, 1/12 to 3 silver, historically dampened swings while capturing upside. Aggressive, from nearer 50-50, accepting sharper drawdowns. Temperament alignment crucial. Best allocation is abandon-proof under duress. Think functionally. What role per tranche? Decades-long preservation, crisis liquidity, currency, geopolitical hedge. Clarity prevents performance chasing. 2026 urgency. Cumulative pressures, debt unrelenting, 38.4 T and rising. Demographics straining entitlements. Social Security shortfall projected 2.8 T by 2035. Politics favoring short-term over discipline point to ongoing inflation repression over austerity. Real returns erode dangerously for traditional savers. Metals opportunity cost plummets despite nominal rates. Volatility clustering. Calm precedes storms. Sudden realizations drive metals, not graduals. Waiting for confirmation costs dearly. Prices up 70% in 2025 already. Treat as position, not trade. Patience over timing. Occasional rebalance. Trim outperforming. E.g., if metals hit 30%, sell to 20%. Add underperforming. Systematizes discipline. Partial preparation beats none. Gradual builds, dollar cost average monthly. Reduce timing psychological risks. Avoid extremes. Metals tools within strategy, not obsession. Integrate with stocks, bonds, real estate for holistic resilience. As 2026 looms, system stress favors debtors, institutions, policy insiders. Savers are wage earners pay. Metals enable partial opt-out, if sufficiently sized. Enough. Sleep well amount preserving flexibility amid purchasing power erosion without liquidity, opportunity sacrifice. Self-derived via risk, goals, temperament assessment. Core takeaway. Preparation acknowledges uncertainty, not predicts doom. Gold, silver recognize policy debt trust limits. As limits glare in 2026, tangible assets role sharpens. Shift from price noise to resilient structure. Thoughtful sizing, disciplined positions you best regardless, exact path. Beyond 2026, if trends persist by 2030, gold could reach $7,000, $10,000, silver $150, $300, amid multipolar world AI-driven energy demands boosting silver and persistent inflation. But focus on protection, not speculation. The window for calm preparation remains open, but closing. Be realistic, not alarmist. Intentional now prevents regret later. Gold and silver aren't just assets. They're timeless safeguards in an uncertain era. Position accordingly, and let history be your guide.